Imagine it's January 2026. You open your investment account on a quiet morning, coffee in hand. The market has been strong for years and part of you expects more of the same. But then you pause because you realize something important. From this moment forward, the future of your portfolio depends not on what happened in the last 3 years, but on what happens next. In one version of the future, markets keep climbing and portfolios grow a little more. In another version, a sudden shift, a shock, a break in confidence, wipes out years of gains in a matter of months. Same starting point, two very different outcomes. Welcome to the 2026 stock market performance. It's about understanding those two paths and making sure that no matter which one becomes reality, you're prepared. The stock market in 2026 is standing at a crossroads. After 3 consecutive years of strong gains, investors are facing one of the most important decisions of this cycle. From here, the market can realistically go in only two directions. Either we get a fourth straight year of double-digit gains, or we are at the early stages of a major financial crisis, similar to 1929 or 2000. Keep watching, and I'll walk you through both scenarios, the probabilities behind them, and what this means for your portfolio. Markets don't move in straight lines forever. The last 3 years were driven by AI excitement, strong earnings, steady consumer spending, and supportive financial conditions. But extended bull markets eventually run into limits. Valuations rise, debt builds, and expectations get stretched. The question isn't whether risk exists, it's whether investors are properly pricing it. Scenario 1, the optimistic case assumes the bull market continues into 2026 with a fourth year of solid returns. Under this outcome, markets grind higher, but leadership narrows and volatility increases. Returns would likely be positive, but not as easy or as broad as in previous years. What could drive this? First, AI must transition from hype to profits. Real productivity gains, lower costs, and higher margins across software, healthcare, finance, and industrial automation would justify higher stock prices. Second, earnings growth must remain strong, roughly 8 to 12%. Automation and cost discipline could support profitability without needing explosive revenue growth. Third, interest rates must remain stable. If inflation stays under control and central banks avoid tightening, valuations remain supported. Finally, liquidity matters. There is still a massive amount of capital sitting in money markets, bonds, and retirement accounts that could rotate into equities. Bottom line for Scenario 1. This scenario has about a 40% probability. Returns could range from 10 to 15%, but leadership would likely be narrower and volatility higher. After 3 exceptional years, upside still exists, but it's more fragile. Now, let's talk about the scenario investors are least prepared for, the more dangerous scenario. Scenario 2 is the beginning of a major financial crisis. Not a normal correction, but a deep structural unwind. Many mega-cap technology and AI leaders are trading at extreme valuations. When growth slows even slightly, markets can reprice violently. There's also a growing gap between AI expectations and near-term reality. AI may be revolutionary, but adoption costs are high, timelines are long, and returns may disappoint in the short run. We've seen this before during the dot-com bubble. Add to that rising government debt, persistent inflation, and higher for longer interest rates. Debt servicing crowds out growth and pressures both consumers and corporations. All it takes is one credit or liquidity event: commercial real estate, private credit, shadow banking, or sovereign debt. When liquidity dries up, markets fall faster than fundamentals. Passive investing and algorithmic trading amplify downside moves. When selling starts, it feeds on itself. Confidence disappears quickly, and exits get crowded. Bottom line for Scenario 2. This scenario carries roughly a 60% probability. Potential market declines could reach 50% or more, especially in overvalued segments. History shows that when bubbles burst, recovery can take years. This wouldn't be unprecedented. In 1929, leverage and speculation led to an 89% market decline. In 2000, technology hype collapsed and the Nasdaq fell 78%. In 2008, excess credit caused a 57% drop. Each crisis looked different, but the warning signs were familiar. Here's the key insight investors often ignore. The risk-reward equation has flipped. There's about a 40% chance of a 10 to 15% gain, roughly a 5% expected upside. But there's a 60% chance of a 50% or greater decline, roughly a 30% expected loss. When the potential loss is many times larger than the potential gain, and more likely, rational investors shift from offense to defense. The math no longer favors aggressive risk-taking. What this means for your portfolio. Best case, modest gains after 3 exceptional years. Worst case, permanent damage to accumulated wealth. When downside risk is much larger and more likely, capital preservation becomes necessary. This doesn't mean exiting the market completely. It means staying invested but not overexposed. Participate selectively, reduce concentration, and prioritize capital preservation. A prudent approach includes diversification, focusing on quality companies, maintaining liquidity, and reducing exposure to speculative assets. It means staying invested intelligently, reduce concentration, and prepare for volatility. Defense is not pessimism, it's discipline, especially late in a market cycle. As we look ahead to 2026, our focus shifts from aggressive growth to strategic positioning. After several strong years in the market, the priority now is risk awareness and capital preservation. That doesn't mean exiting the market, it means staying invested while being more selective and disciplined. First, prudent caution is essential. Overconfidence can be costly, especially when market conditions can change quickly. Second, selective participation. Maintain equity exposure but avoid excessive concentration, and be intentional about where risk is taken. And third, downside protection. The goal is to limit catastrophic losses while still allowing for modest upside participation. In short, 2026 is about defense, diversification, and durability, positioning portfolios to withstand volatility while remaining prepared for opportunity. Implementing a defensive strategy isn't about one big move, it's about a series of disciplined, tactical decisions. First is diversification. That means spreading investments across asset classes, regions, and strategies to reduce concentration risk, especially in areas that may be overvalued. Second, quality matters more than ever. In defensive environments, we want companies with strong balance sheets, consistent cash flows, and proven business models, not speculative growth stories. Third, maintaining a liquidity buffer is critical. Higher cash reserves provide flexibility and the ability to take advantage of opportunities when markets become dislocated. From Market tops are rarely defined by data alone. They're defined by psychology. One of the biggest challenges investors face near market peaks is overcoming the biases that keep them fully exposed to risk, even as warning signs begin to stack up. Recency bias is a powerful force. After 3 strong years, it's easy to believe that recent gains will continue indefinitely, causing investors to ignore historical patterns. Then there's the fear of missing out. Watching others profit while you take a more defensive stance is emotionally uncomfortable, even when it's the rational decision, and confirmation bias reinforces it all. Investors naturally seek information that supports their bullish views while dismissing signals that challenge them. As the saying goes, the four most dangerous words in investing are, "This time it's different." Yet, at every market peak, investors convince themselves that familiar warning signs no longer apply. The first step is to recognize the pattern. Today's market shares many characteristics with previous periods of excess. Second, accept uncertainty. No one can predict the exact timing of a market turn, but probabilities increasingly favor caution. Third, act rationally. Portfolio decisions should be based on risk and reward, not emotions or recent performance. And finally, stay disciplined. Defensive positioning can feel uncomfortable if markets continue higher in the short term, but discipline is what protects capital over full market cycles. Key takeaways: prudence over optimism. Best case is modest gains with a high probability of severe losses. Protecting capital is more important than maximizing returns. A defensive, disciplined approach is the most prudent strategy for 2026. Success will be measured by how much you preserve, not just by gains. As we look toward 2026, success won't be measured by squeezing out the last gains of a bull market. It will be measured by how well you protect capital if the worst case unfolds. When upside is limited and downside is severe, the smart choice is clear. Participate prudently but prepare defensively. In investing, survival always comes before speculation.